Hi everyone, welcome back to Seven Figures. This is episode 16, and as you can see, the portfolio is now at $51,000. It's been about 6 to 7 weeks since I last did an update of the portfolio, and at that time I was highlighting the growth portfolio, which was up 200%. It's now closing in on 300% growth, and the portfolio has actually grown close to $7,000 since that last episode. If you don't believe me, go back and watch episode 15, and it's been a pretty amazing ride to start 2021. Without further ado, we're going to jump into the dividend portfolio and then walk through the other two portfolios afterwards. So here we are on the dividend portfolio. As you can see, it has recovered a lot since the middle of 2020, when this portfolio is down close to 30%. Now we're up 29%. And as you can see here on the earned dividends, we've already earned $437 in dividends, market gains of $15.85 for a total of $20.23. The portfolio has recovered nicely. As you can see on the chart down here, value over time took a really big dip back in March and has slowly recovered. Never lost faith in this portfolio, just knew it was a matter of time before it started recovering again. As you can see, we have $6.81 of dividends here. And it's been pretty nice seeing those payouts happen. So if we go down here and we look at the sectors that are doing really, really well, and if you've been following this channel at all, you know that I'm a big believer in financials, big believer in energy. That's why they constitute 12 and 9% of the portfolio. Even on the S&P 500, they weigh far less. So what I like about M1 Finance, you've got the wheel over here in terms of the pie chart. And then down here, you can quickly do the gainers. Let's look at the gainers here. And technology is still on top at $351, up 68%. It's done really, really well. Alternatives, this is mainly one stock really, Albemarle, which is the aluminum miner. That's up 60% for the portfolio. Financials up 44%. Who would have thought that? And then we have discretionaries down here at 36%, healthcare 31%. But if you look at it, the entire portfolio is now in the green. The worst performers in here are what most dividend investors tend to target, which is the REITs, just up 7.5%. Never been a big believer of those. And utilities. Everyone went out hunting for yield for a long time, especially in the early 2020. And now they've kind of basically seen no growth almost, and a lot of dividends have been cut. Energy is coming up, it's coming back up pretty well, up 25%. I think this will be up 50% in the next 3 months, as we all see oil prices keep going up, energy crises all over the country. So big believer in this portfolio continuing to grow. I wouldn't be shocked if we were up to 50% before the end of really May or June. Just because of where things are and how this portfolio is positioned. But that's really it for the dividend portfolio. It's nice to see that the long-term planning is kind of starting to play out in terms of the macroeconomics of things, the financials, energy. Those things were the two things I really believed in, even more than healthcare, because I thought that was a little inflated going into the crisis or coming out of the crisis. So we'll move on to the next portfolio, which is the growth portfolio. So here we are at the growth portfolio. It's only 10 stocks in here. I've actually made some changes recently. Got rid of some companies that I didn't really ethically agree with anymore. And they're great companies, but I just ethically don't agree with what they do. Namely, one is being Facebook and the other one being Google. I know as an investor, you shouldn't be too concerned with that stuff. But at the end of the day, I didn't really like what those two companies have been doing in terms of data management and being able to kind of sneak around and look at our data. So I've decided to close the positions on those two companies and add other companies that I believe in more. So this portfolio is up, $18,000. Very little dividends. We're up 283%. At one point, we're at 300%, but Tesla kind of lost a little bit of market gains the last few days, and that's pushed us back under 300%. But that's no big deal. This is for the long term, so we don't really care about day-to-day things. As you can see here, value over time, this portfolio has just been a straight line up to the right from the left side. dipped a little bit during the crisis, but came roaring back right away. And this is just an example of like, really investing in companies that you know well and that you believe in. I'm a big believer in Tesla. Tesla is a huge part of my private portfolio outside of this experiment, in the hundreds of thousands of dollars actually. Invitae, I knew about this because of having kids and knowing about the need for genetic testing before birth, things of that nature. Beyond Meat, I'm not going to really explain it, but those are really good companies. It's going to grow fast. Amazon is very dominant, continue to be dominant. Kept buying Uber as it was going down. I also own Uber in another portfolio, which I really like. The new addition has been actually Tattooed Chef. Being somebody that goes to Costco a lot, I started seeing their food all over the place. I actually bought some of their food and I liked it. So I decided to add them in here. I think they're a fast growing company. The revenues are going to continue expanding pretty fast. So it's a 5-year investment, not a 1-year investment. AMD, always been a big believer of them. Microsoft, anybody who works in the office or professional setting knows that they pretty much own the office space. And then Netflix, they just raised my prices recently and I'm not canceling. So they're pretty much a monopoly. They own me. And I think they own a lot of people in terms of not being able to have an alternative. So this portfolio has done really well. I'm going to do the quick gain returns. Tesla is just at a ridiculous level. I think that's 1,867% return. Great. 325 for Invitae, 167 for AMD. Look at Uber, 119. You should buy when they're selling. And then Google up 100%. So I actually didn't get rid of Google, but I planned on getting rid of it. I must have forgotten. And then down here, Microsoft and Amazon 85%. Can't really complain. Everything is up significantly. And I expect Tattooed Chef to be one of those companies that actually does well over time. So reset this back to value. And I think that's really it for the growth portfolio. We'll wrap things up with the Boglehead Portfolio, or the 2-fund portfolio, which is the one I really like to recommend to people. And here we are in my favorite portfolio, which is the Boglehead 2-fund portfolio. There's also something known as the Boglehead 3-fund portfolio. Some people say this is not really a 2-fund portfolio because it's not what Jack Bogle actually had. That's not the case. Bogleheads are really about indexing and making sure that you have asset allocation. So this is more of an asset allocation fund. It's my favorite one because it's steady as she goes. As you can see, it's up 25.64%, which is pretty good compared to almost any investment out there. And when we look at the pie chart here on the left, you can see that the portfolio is almost 50-50 because it's 50% equities, 50% bonds. And the key thing here to look at is the value over time. This is nothing sexy, nothing cool, but it's just a steady climb up. It doesn't spike up or anything. But you can see right around March when we had the crisis hit, this portfolio just went down marginally compared to the other ones because the bonds started gaining in value as equities were going down. And after the rescues took place by the Fed and other agencies, when the equities market started climbing, you can see that this portfolio started climbing with the rest of the market. Maybe not at the same pace because half of this portfolio is bonds. Now, if you want to see what's inside of this portfolio, again, nothing new here. Total World Index Fund, it's the first one. It's up 45.74%. That's better than most portfolios out there, and that's beating the dividend portfolio. So that's really important to keep in mind. If you're a dividend investor, you don't want to take the time to research things, you can just pick up an index fund like this. It'll pay you 2%, not as big of a dividend payout, but you'll have better equity returns and you have less gyrations and you have more free time to actually do other things. The bond part is down now only up 6.6%. That's because bonds are losing value right now in terms of the interest rates are going up, so the value of bonds is going down. And that's kind of what's pulling this portfolio back and making it, instead of being up 45%, it's only up 25% because the bonds are pulling it back a little bit. Not too concerned with that. It's exactly what I think should happen. And I really recommend this to almost any novice investor, someone starting out. First start out here, learn about investing, and as you become more comfortable with it, you can start deciding what style you want to take on. Anyway, that's really it for today's episode. If you like the concept, you like the content, and the experiment, please give this a thumbs up. And don't forget to subscribe and share with others so that more people can actually discover the content. Thanks very much and have a good day.